Okay, perfect. We'll record. Mute that. Okay, perfect. All right, it's 10:04. We'll start. It is Columbus Day. Not too much news for today. The biggest thing that we're going to be seeing for this week is consumer price index, and we're really going to kind of go over essentially what's really happening with the Fed for the most part, and hopefully some good news that's going to come soon, and if not, what those kind of consequences can look like, at least for us in terms of interest rates and stuff like that. Because I think the biggest mover right now is not really anything else except for interest rates. It's not the concern of a recession for a lot of our borrowers. It's not the concern of losing a job or anything like that you typically would see. It's just about affordability, right? And then most importantly, rates continuing to climb. And so a lot of borrowers are feeling that kind of intertwined with that higher purchase price as well as interest rates. So we really need to kind of see, and we won't ever be able to actually gauge when it's going to happen, but we need to kind of know what's going on for the most part and when this thing can possibly end. And as of right now, I'm usually very optimistic. It's not that I'm being pessimistic. It's just I'm kind of seeing the writing on the wall, and it seems like it could be a little bit longer than what we expect. And I'm going to jump into that today. So Kathy Jones, the chief fixed income strategist for the Schwab Center for Financial Research, she believes that the worst in the bond market is behind us. She stated that the bond market was the first into recession-like conditions and will probably be the first one out as well. And the fact that the yields do look attractive now at 3.88% returns as of today, even though the market's not open today. But basically, for those of you that don't know, as with the bond market or the 10-year Treasury, that's what's really correlative of mortgage rates long term, right? So as the bond market increases and has a higher yield, interest rates are going to also increase. As U.S. Treasury decreases and that rate of return is less because there's more people investing their money into the bond market or into U.S. Treasuries, interest rates decrease as well because you get a better return on those interest rates over time. And so the biggest enemy that we're seeing is inflation, right? But also it's a little bit more than that as the Fed continues to tighten and do their quantitative tightening here. And I'm pretty much, like I said, it's not because I don't think I'm being pessimistic. I'm usually the most optimistic one. But what we're seeing what the Fed is doing is they're putting a fire to inflation as much as they can and thinking that they're going to control it by continuing to raise their Fed funds rate. And what's happening is they're creating illiquidity in the bond market. And so investors and banks, they're not putting money into anything. Instead, they're trying to be as cash heavy as possible. And because they're trying to be as cash heavy as possible, we're not really seeing any money going into U.S. Treasury bonds or anything like that. And as we take this month to month, with CPI reports, which is the consumer price index, and PCE reports, which is personal consumption expenditure reports, the biggest thing that we're really going to see a pivot on from the Fed is if inflation lessens, which we know this, but that's a big if inflation lessens. We're assuming that over time it will, but how long is that going to take? That's really my biggest concern now. We thought it was going to be towards the end of the year. We're hoping that that's still the case. But we're seeing now that inflation is a lagging indicator, right? So a lot of these inflation reports are coming in, even though they're month to month. A lot of the stuff that's in the inflation reports, like rents and things like that, those are lagging indicators. Either way, I do hope that Ms. Jones is correct, because if the worst is behind us on the bond market, that means that rates are just going to get better from here. And I hope that's the case. Now, this is also unfortunate but true. Jobs report data came out from last week showing 263,000 jobs were created, and unemployment came down to 3.5% from 3.7%. Now, that is great news for obviously the overall health of what our economy looks like, but it's also very bad because this is a significant indicator for the Fed, right? Basically what they're doing is if people are not losing their jobs, what they're thinking is that's going to continue with inflation over time, because those same people that are getting jobs are spending money, and that's going to continue to increase inflation. So they literally need to see us or the economy losing jobs in order for them to also most probably pivot. They have said that they won't, but if we can see those two things, inflation come down or people losing jobs, they're going to eventually stop that and pivot it, and pivot their hiking of Fed funds rate and stop squeezing money out of the markets. And then from there, we could see a retraction back to where we were before. If we can get good news on inflation or bad news on jobs, like I mentioned, we can see bond markets react well. But until there is some sort of like sustainability, we won't see much long-term success. For instance, this Thursday, we get consumer price index, right? If we see negative 0.1% month over month, right, that's good. That's going to put our yearly down as well. And that's going to be good short term. But the market is still going to be scared about what the Fed is going to do in November, if they're still going to hike rates, even though we saw that consumer price index come down 1 month. So you're not going to see the bond market react well. Now, since their meeting is in late November, we're still going to get that November reading before the Fed funds meeting. So now if we get 2 months of consecutive negative inflation, what is the Fed going to say there? Now, if they say that they are going to, instead of doing 75 basis points, which is what they're thinking, maybe they do 50, 25, all that stuff is going to be good news for interest rates, for the market in general, and things like that. But it's really all dependent right now. Everybody's kind of looking at the Fed long term. So even though the Fed funds rate, where that number is, doesn't directly correlate with interest rates long term, because of the actions that the Fed is taking in terms of what they're doing to our economy and to the world economy as well. They're pretty much crashing the world economy as well. You guys, I don't know if you guys see, but because the dollar is now worth more than the euro, that's hurting the European markets. And so they're having to kind of pivot, because everything around the world revolves around the US dollar. When you're talking about gas prices, you're talking about investing money into Europe. Let's say last year you invested $100,000 into Europe. That money, or $1 last year was €1 was worth 121 last year, I think, or 120 something last year in terms of the US dollar. So if you invested that money, you sent $120,000 to invest 100,000 euro, right? Let's say you got a 15% return. That means that you ended up getting 115 euro. But now if you try to take that 115 euro back to the US this year, you actually only net like 111,000. So you lose like $10,000 over the year, even though you got a 15% in Europe. And so this is why, if you saw that the UN is trying to stop the Fed, or asking the Fed to stop hiking their Fed funds rate, it's because of things like this, right? They're hurting the overall national, pretty much the economy in general. So we'll see. Hopefully, like I mentioned, unfortunately, job loss is good for interest rates right now, for the Fed to kind of cool down so that the bond market can react well, and as well as lower inflation is going to be good for them too. Lastly, CoreLogic released their home price index for August, and that showed that home prices fell 0.7% month over month, and they're now at 13.5% year over year, which is down from that 15.8% number in July, I believe. Remember that there are a few companies that do these home price indexes. So last week we went over Case-Shiller, and that's the one that they typically, basically, they take their time on doing these home price indexes, and so they're usually 2 months behind. CoreLogic is the first reading that we're getting for August, so it's good to kind of see that number. Their negative 0.7% month over month is still very, very minimal for what's happening in the market, I guess is the best way to put it, for the most part, right? And they do believe that this month is going to be flat in terms of there isn't going to be any gain or loss in terms of home prices, and that we're still going to see 3.2% year over year home price appreciation, which it's a slower market, but it's still normal conditions. Remember, a normal market is anywhere between 3 to 5% home price appreciation. And so, like I tell you guys, even though that year over year number is coming down every single month, last month was, the month before last was 18%, then it's 15, then it's 13. It's fine, because we have to get back to that normal market anyway. I'm not too worried about that number coming down right now, until we get to closer to that 3 to 5%. And then at that point is really where we want to kind of see where that's headed. Because if we see that get closer to 2%, 1%, and then we see it go into the negative, now that's no longer home price appreciation, that's home price depreciation. And then that's where people get, very, very, very nervous for the most part. But that's pretty much the big news. It's really, we kind of need the Fed to stop hammering the Fed funds rate, but we also need inflation to slow down in order for them to do that. It's kind of really a catch-22 because we don't know, especially if you guys remember, this is the last month where last year's reading was low, right? When we're talking about inflation being year over year, remember they take over the last year's readings and replace them with this year's. And so last year's September, I think, was only 0.2% or 0.3%, as opposed to last year's October, which is going to be 0.9%, which is why it gives us a better, October is a better reading for us, which we're going to get in November for us to see negative inflation. But if we still see 0.1% month over month, because that's what they're looking at, they're not looking at the year over year. They're looking more right now in the short term at the month over month. So if that continues to be at 0.1%, 0.1%, 0.1%, even if it's positive, whatever that positive number is, it's not going to be good for us come November when they try to do another rate hike, essentially. And that's going to, in total, it's going to kill the bond market as well. So we need to cross our fingers for Thursday. Hopefully we get a negative reading on Thursday. Hopefully we get a negative reading next month so that by the time the next Fed funds meeting comes in, they lower their expectations or they lower their raising of the funds rate from 75 basis points maybe to 50 or 25. All we need, even if they continue to do it, what the market wants to see is them kind of slowing down, right? And so if they show any sort of sign of slowing down, it's going to be beneficial for us moving forward. But I think for the next month and a half, until we kind of get a better gauge of what the Fed is doing, we're still going to be in rocky seas for the most part. Hopefully we see some good news by the end of the year, which is going to be in their Fed with their meeting in November and in December. But that is pretty much it. I don't know if you guys have any scenarios from last week that you kind of want to go over, any questions or anything like that in terms of hometown heroes, in terms of 2-1 buy down, anything like that you guys want to discuss. No questions. Right now, the best thing is to push that 2-1 buy down, by the way, guys. It is because of and I say this pretty much every week because I really want you guys to tell your clients that they can get a lower interest rate. And what we have to do, we just have to fight sellers. We just got to fight sellers, try to get the credit so that the buyer doesn't have to pay for it. But that's ultimately what you want to do. Okay, if you guys have no questions, no comments, no scenarios or anything like that, we're pretty much good for this week. Next week will be pretty interesting because we will have that CPI come in. So we'll talk about it in depth and see how it looks for the market or how it ended up looking for the market, if it ended up being positive or negative and stuff like that. But ultimately, hope you guys have a great week. Anything that you guys need from us, you can reach out to us.
Thank you.
Thank you, Mike.
Thank you.
Thanks,
Have a good
Mike.
one.
Thank you.
Thank you.